I'm Michael Casey, Chief Content Officer at CoinDesk. Great pleasure to be here. Really excited for this conversation. We can pretty much get started. We've got Gordon Liao, who is the Chief Economist at Circle, and of course Niall Ferguson, author, historian, guy from Milbank Family Senior Fellow at the Hoover Institution is the formal title, but I'm sure you all know Niall's work throughout the years. Look, this is going to be, I think, for me, just to level set from where I'm coming from, I've been covering this space as a journalist for coming up on 10 years now, and I think that one of the things that's been really fascinating for me is how much, when I went down the rabbit hole, as people do in the crypto, initially it was just Bitcoin back in those days, moment, you start to sort of really delve into what money itself is. And one of the first books I read as I was doing that, of course, was The Ascent of Money. And it's a fascinating process. And I think as this technology has evolved, it's had its ups and it's had its downs, we now know recently. It continues to ask, I think, questions. And that's kind of what I think we'll be doing today, is to explore some of those questions. So, to kick it off, Gordon and I had a bit of a chat beforehand, Niall, so you're going to have to just accept what it was we agreed to talk about. I think, one of the things that, economists typically come back to you and they tell you money is a unit of account, a medium of exchange, a store of value, and a unit of account. And, everything gets dismissed on that basis because it's everything. Bitcoin is not this, or gold is not. All these things are not that. But I often feel as if those terms are fuzzy, those ideas are different. And as technology moves into this space, and we're going to talk a little bit longer about programmability of money, which is a whole other dimension to what money can be. How reliable are those old definitions? I mean, can we challenge those concepts with technology? Do we have to accept the 3 rule? Is there some things that can be 2 and not 3?
When anybody is quoting an economics textbook, you should be very suspicious indeed. I wish I had a Bitcoin for every time I've heard Nouriel Roubini walk me through the 3 definitions of money. One of the advantages of being a financial historian is that you're not encumbered by economics textbooks. When you look over the history of money, or maybe I should say of payments, of finance, you realize that there are all kinds of gray areas. And I'll just illustrate the point with a simple example. After the Black Death, we are in a post-pandemic era now, so it's worth looking back at a much worse pandemic. There was a chronic shortage of coinage as the European economies became more monetized and moved away from feudal payments in kind. For merchants, especially those engaged in what we now call cross-border trade, this was a problem. How could they solve it? And the answer was with bills of exchange, IOUs, usually for 2 or 3 months, that were the key financial instrument for the expansion of European trade from that period in the late 14th century right down to the 19th century. Without bills of exchange, you don't have the first stage of globalization. Now, what are bills of exchange? Are they money? Well, no, but they're a way of paying for stuff that was highly efficient and did not require third-party verification by any state entity. Bills of exchange didn't have the heads of sovereigns on them. They just had the signatures of merchants. And as the system evolved, it became very sophisticated because instead of the IOUs simply being IOUs between the vendor-buyer, they started to be discounted. People would countersign them. And in fact, bills of exchange were the first network-based system of payments that the world has seen. You could argue that what cryptocurrency did was to kind of reinvent that idea, taking advantage of the new technology. So I actually don't find the classic textbook definitions of money at all helpful when it comes to thinking about the processes of financial evolution, which are constantly changing the nature of payment itself, constantly changing the ways in which value is stored, constantly asking us to think of new units of account. It would be very odd if those 3 classifications always held good and were some test which something has to pass to qualify as money. I'll just pay tribute to my colleague Manny Rincon-Cruz's excellent observation in one of his recent blog posts that there may be a trilemma embedded in the three definitions of money. It may in fact be the case that nothing can satisfy all three of those things.
Yeah.
You can maybe do two, but not all three. That was his idea, and it's a very good idea.
Yeah.
Well, that is a really, really interesting perspective from a historical perspective. I would like to add, Michael, you asked earlier about programmability of money. I would add another feature that I think in the future we could leverage that will be a core part of money, which is the programmability, that the fact that you could digitize dollar or euro or whatnot and put it onto blockchain as a form of token that instantly make money as easy to program on as it is for data. So today, 60% of our USDC transactions are related to smart contracts. Now, some of these smart contracts might be related to, say, decentralized exchange, but others are fundamental and core to custodying of assets through a smart contract safe, through escrow accounts, these if-then statements that could be embedded into basically money. Now, previously when I was at the Federal Reserve, looking at programmability as a concept really excited some central bankers as well. Wow, you can potentially get away with zero lower bound by introducing certain features in money. Well, we also seen what happened, in taking that test to that limit too far with the case of the Chinese yuan, which they probably have taken it too far in how much programmability they have embedded, also privacy concerns, among others. But this concept of new features that we can introduce to money, in this case programmability, I think is good to keep on your mind as money continue to evolve, potentially acquiring new features. And as Neil said, maybe some of the features do not necessarily need to be there for certain use case.
So I think that also speaks a little bit to what Neil's saying as well. It's like if you have these three rigid definitions, then how do you ever add a fourth one and so forth? And so the fluidity, the spectrum-like way of thinking about this, I think, is really important. But one thing I'd like to maybe pick up on within that is like bills of exchange, a great example. You talked about them being IOUs and then being, from time to time, discounted, right? We don't really want our money to be discounted, right? We want our money always $1 is supposed to be worth $1, et cetera, et cetera. However, again, I lived in Argentina for 6 years, and there's this thing called the patacones, I'm sure you know about, that were introduced by provinces that went, there was no money around. Basically, the deflation at the time had tied it up, and the provincial governments were issuing these bonds to their employees to pay for, because they didn't have any cash, to actually literally pay for their services. And those things were immediately discounted. But the fact is they still functioned as money. Like people understood, okay, this Patagon is not worth the $100 face value, it's worth $50, but it's still money. And that I think is just really fascinating. And then, but at the same time, and this is where the whole stablecoin regulatory debate gets very, very interesting, that struggle to try to find the moment where it cannot be discounted, that it truly is trusted for being the one-to-one face value that it is, seems to me the core challenge of what we're discussing in this stablecoin environment. And Neil, I'm going to throw to you on this because the reference that some critics of stablecoins come back with is, of course, the wildcat era in the US, when we know that certain dollars, guys who are familiar with this, maybe you should give the historical reference, you'd know it, but clearly some of the dollars issued by these different regional banks would end up being discounted. And some people are comparing that to stablecoins. I have a view as to why that's a really fallacious apples to oranges comparison, but maybe walking that through might be a good way for us to discuss the importance of what a true one-to-one reserve is, et cetera, et cetera.
Well, it's a talking point for critics of stablecoins that they somehow want to return to the era of wildcat banking. And wildcat banking is one of those phrases like tulip mania that you can say without knowing what you're talking about. And it sounds somehow as if you do know what you're talking about. So it's not clear that this is at all a good analogy. 19th century American banking was peculiar partly because of its very unusual decentralization. Because of the remarkable autonomy that note issuing entities had, and because of the almost total lack of regulation. So in the mid-19th century, you would have directories that would allow you to look up and see how bad, how dodgy a particular banknote was. Now, I don't think anybody envisions a future in which we get back to the Wild West. I mean, there were some people who seemed to aspire to get us back to the Wild West. When Sam Bankman-Fried sprung onto the scene, I wrote a column back in May of last year for Bloomberg in which I said this wasn't so much the Wild West as the Wacko West. So I think, you could see that, as with any financial innovation, there would be frauds and scammers drawn towards it, as well as speculators. But I don't think the wildcat analogy works. I'm going to hand it over to Gordon to explain why, from the vantage point of a contemporary stablecoin, it really doesn't work.
Yeah, first of all, I would say that not all stablecoins are created equal. There are payment stablecoins, and for us, we sometimes like to call ourselves tokenized cash, USDC, being truly, almost a cash equivalent, in that it is fully backed, fully reserved, one-to-one, with right now is 80% T-bills, less than 3 month maturity, and 20% are held in banking accounts. Now, this full reserve model is quite different from the wildcat banks back in the day, in that the asset liability mix of the wildcat banks were completely different. They had all sorts of different assets, some of which were safer and others were less safe. So anytime you have more than a couple of months of maturity transformation and credit transformation, of course you introduce differences in the exchange rate for the note in which you're trying to pay people with. Now, bringing to today, there's also an active discussion about tokenized deposits, or sometimes it's called, there's a program called Regulated Liability Network, in which some of the banks are also thinking about, well, could they create something similar to a stablecoin? And I think it's really hard, and that would actually bring it closer to the wildcat banks in terms of the asset mix. Now, of course, we have a lot of regulations these days for banks, but having the assets being of different type of maturity, different type of credit quality, having assets of banks having different capital ratio, leverage ratio, et cetera, and putting it out into a network structure that you could actually trade one versus another, I think that is, kind of resembling the fact that what you said earlier, that there are exchanges in the past where you can have different notes trading at different discounts. Now, I think having a very high standard, this is why we need policymakers to make the regulatory needs to satisfy this very high quality standard of full reserve model for regulated payment stablecoin that could standardize the asset structure of payment stablecoin and dictating it to be highly safe and highly liquid. So that would be the difference.
It's surprising to me that financial journalists such as Martin Wolf don't embrace that argument, considering how many times they, after the financial crisis, criticized the established model of fractional reserve banking and money creation by banks, which is the system of our time. But oddly enough, financial journalists have gravitated more towards the Bank for International Settlements view that all innovation is bad and it should all be shut down and replaced by central bank digital currencies. But that seems to me like a slight contradiction in the line of thought. Anybody who was critical of the existing banking system back in 2008, 2009, and you'll remember all those articles in the FT and elsewhere saying how dreadful the banking system was and how it had to be radically reformed. What we wanted was no more fractional reserve banking. They should all be in favor of what you're doing, Gordon, but I haven't seen those articles yet.
Well, yeah, I would add, it's not like, I don't think the biggest competitors for something like payment stablecoins necessarily bank deposits. I think many regulators are afraid of that as well because, in some ways, I don't think the on-blockchain credit intermediation is there yet. It's pretty far away. So we don't want to disrupt credit intermediation in any way. But let's put it into perspective. There is more than $2.2 trillion of physical cash, dollar bills in circulation, 80% of which are $100 bills. So there's already a huge opportunity of just tokenizing those physical cash bills into something that's digital, without disrupting the banking system, without disrupting credit intermediation, without competing necessarily for deposits. I think that more, perhaps complementary tone instead of adversarial could actually help further discussions and policy.
So let's shift gears and look at this from an international perspective. And I think that one of the interesting ways to think about what happens when money is programmable, when it can flow across borders. And Jeremy Allaire likes to say frequently, there is no such thing as cross borders in a true sort of open architecture model for money, just as there is no cross-border email. Money is just there in a kind of a digital sense. But when we think about that global implication, the prospect that we get hyper-dollarization in the rest of the world when it is now a free-flowing thing and everybody wants this, starts to raise questions about monetary sovereignty, about the shape of the world. Where do you see this going? This is a discussion about the future of money. We've done a lot of talk about the past so far. Let's just go to the future.
Well, there's a debate going on right now about whether the dollar will remain the dominant reserve currency and the dominant currency for trade in the coming decades. My good friend Barry Eichengreen at Berkeley recently published a paper showing that, in fact, there had been some decline in the dollar's dominance. And he imagines a return to a more 19th century world where there are multiple reserve currencies, where the euro is seen as comparable to the dollar in its importance. Obviously, the Swiss franc plays a role, the yen, the pound, and so on. But that's not quite what you're asking.
No.
I mean, you're asking.
Well, maybe it's a multi-currency environment that's such as that Barry's talking about, but now it's just more fluid because this is the digital transferability or substitutability is actually greater.
Yeah, I mean, I think that debate assumes technology is static, whereas we should really be factoring in the drastic changes that lie ahead in payment systems around the world. There was already an enormous shift happening in China before the ECNY was dreamt up, being driven by the centralized payment platforms developed by Alipay and its WeChat equivalent. And at that point, when those were riding high, China was ahead in some ways of financial innovation. And there was a plausible scenario back then, I'm thinking 4 years ago, when you could imagine Ant becoming the dominant payment platform in multiple emerging markets. And I certainly thought that was a meaningful challenge to dollar dominance, simply because the convenience would be so irresistible. And when I talked to the people who were masterminding the expansion of Ant, they had a very coherent blueprint for how they were going to make that payment platform ubiquitous and irresistibly attractive to small businesses in emerging markets. It was clever and it was foolish of Xi Jinping to kill that, because it really would have given China a far bigger shot at challenging the dollar than the ECNY has. I mean, I think there's enormous inertia in international payment system, even allowing for technological change. What's clear, though, going back to your Argentine example, is that in multiple countries around the world, financial and monetary instability is getting worse. Argentina has 100% or thereabouts inflation right now. It's not the only country in that situation. Although we are complacently telling ourselves, oh, inflation's coming down, that was just a kind of blip, Team Transitory was kind of right, just a little bit wrong in their timing. Around the world, it's far from clear that the shock of the last 2 or 3 years has begun to wear off. So there are lots of places where there's monetary instability, financial instability, political instability, and people have a legitimate fear of having such wealth as they have tied up in local currency. Now, if there are solutions like USDC or others, and Bitcoin is clearly an attractive solution in some parts of the world, you can see that in the uptake in Turkey, uptake in Brazil, etc. There is going to be an extremely interesting competition to see who can provide a safe asset stroke money stroke means of payment for the dangerous parts of the world. And the dangerous parts of the world are becoming larger, not smaller in terms of population. I could certainly see Circle answering a very substantial need around the world for a dollar equivalent online means of transacting. And I'm imagining that is indeed part of your strategy.
That Circle becomes the next Ant, right? I mean, that to me, to be honest, that sounds a bit scary, right? As much as I have great regard for the team, know a lot of Joshes over there. Jeremy goes way back. Dante, love you all, but I do not want the world to be run by Circle. I do not want the world's money to be run by Circle, right? So I
thought that was why we were here.
fighting the good fight here, guys. So, maybe just speak to that if you can. Just the responsibility that comes with this, and therefore, like, how do you address concerns about? Yes, there may well be a threat to sovereignty in these developing world countries. They make it a much better form of money than they currently have in somewhere like Argentina, but it is a sovereignty question.
Absolutely. Dollarization is one of the hot topics that come up when we're in discussions, especially with the international policymakers. And I think, we both have a responsibility to nations, states, to have sovereign money, to have their own monetary policy that could stimulate the local economy, but also to the everyday consumers that need an alternative form of saving. And regardless of whether digital currency are around or not, many parts of the world do have quite a bit of dollarization going on. So, Argentina, you brought up, well, of course, there is the black market exchange rate and the official exchange rate, similarly in many parts of the world. So dollarization is happening regardless of whether there is digitalization or not. Maybe digitalization pushes different regions a little bit further. But at the same time, one of the reasons we launched the Eurocoin is, in particular, in response to that. We don't think that U.S. monetary policy should be driving all of the economy everywhere, and different regional blocks potentially could benefit from currencies that are centered in that region that could stimulate the local economy. Now, would it be every single country that has their own stablecoin? Probably pretty far from that, but I could possibly see that every major currency region, having their own version of USDC or Eurocoin, in which monetary policy could pass through relatively easily.
So on this idea of this intensified competition that we seem to be gearing towards here, right? And we often the ECNY you've mentioned, Neil, like, it's a centralized model. It's a model that raises concerns about surveillance because simply the capability is going to be there when every transaction is on a centralized ledger. One of the arguments for stablecoins, or even more so perhaps for even Bitcoin, is that it doesn't reside in that centralized context. Does that become part of the competition? Like, is there an opportunity, in fact, for regimes that don't feel like they have to monitor their citizens to now actually enter into this competition with a more sort of pro-privacy model? And to be honest, I'm not convinced that US policymakers understand that opportunity. They just are doubling down on KYC AML structures, which are essentially a jury-rigged version of the same surveillance model, right? So, I mean, I've often thought that this is an opportunity for the United States, like, get out there ahead, an open form of money, but I'm not convinced they have it. Anyway, it seems to me like that could be a key part of this competitive challenge.
Well, we have a problem which I guess can be traced back to 9/11, and that is that in the Western world, and particularly in the United States, the notion evolved that in practice all transactions should be viewed with suspicion and therefore should be accessible to the authorities. And while in the atmosphere that followed 9/11 it was possible to curtail civil liberties quite drastically with popular support, a long time has passed. It's now 2023. And it's far from clear to me that we should be competing with the Chinese Communist Party to see who has the best surveillance. I mean, ultimately, there are all kinds of threats to individual liberty that we underestimate. The national security argument's one of them. Then there's the enormous amounts of money to be made from digital ads, which, of course, is Meta just across the road. But, I mean, mentioning no names, that certainly undermined privacy drastically. And then there's our own laziness. I was just saying to Jeremy earlier, I wish I had a Bitcoin for every time I've clicked on I agree or I accept without really bothering to read the small print. So in all kinds of rather disturbing ways, we've allowed a culture of surveillance to establish itself to the point that we barely question its legitimacy, whereas in truth, it should be a fundamental difference between the West and China, that the default assumption in China is that everybody's under suspicion and under surveillance, and that is not the case. That if the authorities have reason to believe that you're up to no good, they should have to show that reason before they can take a look at your transaction history. Part of the problem with the recent debates, I was discussing this with Peter Thiel recently, is that the federal authorities began to say, well, we like Bitcoin because it's so easy to trace transactions on an unalterable ledger, and that fairly undermines the old libertarian arguments for crypto. I think, and this is the kind of rub, you have to have a financially better educated citizenry before people recognize the value of privacy and the extent to which it's been undermined. Right now, there isn't really a huge demand for it. There ought to be, but there really isn't. And so, in effect, we just have two different surveillance regimes: the Chinese communist surveillance regime, and then the private sector regime forced by the National Security Agency that we have in the West.
Yeah. So education. Get yourself. That sounds like a more vital thing, in fact, necessary than actually the policy itself. I'm going to turn into a pumpkin, or Cinderella, about to get out of here right now. So, final words, Gordon, so I can get out of here.
To the last point that you were going to say, I think blockchain is not necessarily a black and white question about openness or closeness, permission or permissionless. There are implementations in which you could have a reasonable level of regulatory control, have a reasonable level of compliance, yet at the same time still have the permissionless type of underlying infrastructure. So I think we're still in the early phases, and there's so much to experiment, so much to learn from all this experimentation that's flourishing. And hopefully, with the right help, with support from policymakers and industry partners, we could get to the future of money.
Landed on the exact phrase of this title here. That was a nice closer. All right, a round of applause for these two people. Thank you very much.
Thank you.